will come from the banking sector. And hence, I'm really looking forward to hearing our colleagues from different Nigerian banks later on today. And so the Green Tagging Project and resulting Nigeria Green Banking Tagging Review have positioned Nigeria's banking sector to continue its climate finance leadership, which is absolutely fantastic. And it's why we do this work. And that's why, again, demonstrating Emmanuel's leadership within FC4S Lagos. And of course, the banking and having the banking sector lead on this is key for the Nigerian economy, but not just for the Nigerian economy, given how important Nigeria is as a country to the overall African economy and the reliance on Nigerian investment capital. This will also spread out among different countries in the region. And indeed, when it comes to climate finance, banks can't achieve their own KPIs if they don't first assess where they stand from a risk perspective. And so in many jurisdictions, this rigorous climate risk exposure analysis that has just been done has not been done yet. So again, the reason why I pick on this point is it's underscoring Nigerian leadership in green finance. And then once these climate risks start to be disclosed, we can track the financial system's progress and set ambitious yet feasible targets. And the fact that this analysis has happened here in Nigeria, and we're talking about it today, means that Nigeria's financial system has a real solid base of which to build. And so as I come to a kind of an end on my remarks, it's very clear that the Nigeria Green Banking Tagging Review provides the country with a sustainable finance roadmap and offers a path towards addressing green finance data gaps, adopting international standards, and fostering financial sector capacity building. And talent development is a key one, and this is something that Emmanuel and I share. How do we build the talent within the financial ecosystem at the policy, regulatory, and market perspective to ensure we can develop new products and services in a regulatory framework to even meet those targets and to unlock that near 100 billion which is required in Nigeria and the Nigerian economy out to 2030. And so with this monitoring and disclosure framework that we're launching today, and for it to be implemented, public and private financial actors will be able to foster further green bonds issuance and systematically link institutional investors with green investment opportunities in Nigeria, and perhaps, as I said, further afield. And so FC4S Lagos played a key role in supporting the development of this green tagging project and framework for green loans reporting. And we as FC4S, UN convened FC4S, with Emmanuel, are planning on a deep dive analysis on the talent gap on sustainable finance in Nigeria to push the sustainable finance skin out further in the country. And this will ensure, as I noted earlier, that the country is well equipped with human capital to overcome sustainable finance challenges. And so looking forward, we as the FC4S Secretariat and collectively 39 international financial centres will continue to provide the tools and insights to support Emmanuel and FC4S Lagos in their next steps along their sustainable finance roadmap. So today is a unique opportunity to get involved, to get stuck in, to reflect on Nigeria's progress and also discuss achievable next steps under the leadership of Ola May, who's going to moderate the session. We are joined by sustainable finance experts from the private sector, government and international community today as part of this panel, which is super. And then collectively, we're going to discuss how can we ensure Nigeria's financial system both avoids climate risk and capitalizes on the near 100 billion and annual sustainable finance investment opportunities that need to be achieved. So with COP27 coming up in Sharm el-Sheikh between the 7th to the 18th of November, which is less than 300 days away, this will be a big chance for Nigeria, not just showcase its leadership to date, but also build excitement around its green finance ambitions going forward. And we look forward, as a key member of UN convened FC4S, we look forward to working with FC4S Lagos to ensure that we're well positioned and promoted at COP27, and that Emmanuel is right there with us as a member of our steering committee. So Olame, I think I went on a little bit too long there, but I'm excited about today, and I want to welcome the launch of today's important document, and then again thank Emmanuel for including FC4S in today's session. Back to you. Excitement around green finance ambitions.
Thank you very much.
And we look forward as a key member of UN.
I'm not sure. I'm actually getting some feedback here, but I don't know if that's the same with everybody else.
We're well positioned.
But I'm hoping it's not the case.
Emmanuel,
without further ado, my name yet again is Olumide Lala. I'm the director and co-founder of Climate Transition Limited, a boutique consultancy firm with a focus on sustainability and risk management, climate finance risk in Africa. Today, I have the pleasure of inviting a panelist of financial experts from the Nigerian banking sector, to have a discussion yet again on this topic before the project is launched. However, I would want to also say this, that we are expecting the Chief Economic Advisor to the President of Nigeria, Dr. Doyin Salami, at some point join this panel discussion to launch the report for us. Whilst that is scheduled to be done after the panel discussion itself, unfortunately, Dr. Salami will be stuck in between a couple of meetings this morning. As you can imagine, a man of his office clearly has to react to the presidency whenever he's called, and as such, I would be much obliged if we can accommodate him sometime during the morning, perhaps during the discussion itself, to just take a bit of an interlude for him to launch the report. If that were the case, then we will get back to the launch at some point much later, back to the panel discussion much later. Now, today's discussion will focus on certain key areas. The discussion itself, today's discussion would focus on 4 key areas, which evidently will speak to what the report actually was meant to bring to light. Some of the things we looked at and the recommendations that were given with the report itself were things to do with how to mobilize private sector investment to bridge infrastructure deficits, especially developing pipelines and digital information within the Nigerian sector. What is the role of non-financial disclosures in guiding investments? Clearly, there's an importance when it comes to regulatory surveillance and enhancement of reporting mechanism to enable the tracking, measurement, and the capacity of banks and financial institutions to respond to climate risk. Also, how policy incentives, especially from the regulators and some from DFIs, can accelerate the implications of a clean energy transition. As we all know, energy poverty is a massive issue with Nigeria, and a country with 200 million people needs excessive power to be able to develop that economy. So, what are the capital adequacy requirements and innovative financial products and instruments that we need to bring to bear to enable us actually meet this goal? Not necessarily the NDCs, but actually our developmental needs and objectives and ambitions. Finally, how do we, using innovative financial instruments such as green bonds, how do we scale that issuance up to be able to green the economy and highly exposed asset exercises which the banks currently face? To join me in this debate this morning, I am extremely pleased and glad to welcome the following. Mr. Haruna B. Mustafa is the Director, Banking Supervision at the Central Bank of Nigeria. Mr. Mustafa, you're welcome. I'd also like to welcome Mr. Olutoye Bekomo Ambi Ekomo, the Chief Risk Officer, Sterling Bank. You're welcome, sir. Also, I'd like to bring in Mrs. Ijeoma D. Ozulumba, who is Executive Director, Finance and Corporate Services, Development Bank of Nigeria PLC. You're welcome, madam. Finally, Mr. Silvanos Eneche is the Chief Risk Officer at Wema Bank PLC. You're all welcome to this debate. I don't know if we can all see you at this point.
Olumide.
Hello.
Hello, Olumide, can you hear me?
I can hear you.
Yeah, there appears to be some echo at the background that is interfering with your audio.
Yes, he has to turn off his YouTube channel. I think there's a live broadcast on YouTube. Olumide, if you can just turn it off or mute it, the YouTube channel.
I think that Illumide might be encountering some technical difficulties right now, so I'll just quickly step in and queue a few questions for the panelists while we wait for him to rejoin us. So I was wondering, how can banks help support new companies in this area of development, green finance and climate finance, given that many may not overcome the conservative risk assessment criteria, which will be applied from more traditional areas of business? And Sylvanus, I was wondering if you might have any thoughts on this question of how new companies can access green and climate finance.
Okay, thank you very much, Ryan. Well, in the first instance, I think we need to look at it from the perspective of the fact that even banks are essentially coming to terms with green finance, as it were. A lot of us have had to look at our portfolios to assess what we're doing. And happy to say that we did this in Wema Bank with the support of FC4S. We were part of that report that is going to be launched today. And essentially, I think coming to understand what is before us, it's a major issue. It's a risk issue, as most people would say. So before we even go on to advise clients and also enable them to take positions that will help them in that transition, we ourselves need to understand. It needs to be one that you understand what your portfolio looks like today, what are the risks before you, what are the kind of stranded assets you could have going forward. I use the example of the typewriter and the computer. I mean, you could have been the best typist, but when computers came around, there was a transition. Some people got stranded. Some people, their skills were no longer fit for purpose. It's the same thing that is happening in finance. At a certain point, if your project, if your solution is not tagged green or sustainable, you might not be able to find financing for it. For us as institutions also, what it means is that unless we position ourselves appropriately, ultimately sources of finance, investor interest in Nigeria as a whole might dry up. So there's that need to continuously understand what is happening, the transition is occurring, and also start to enlighten your board, and as an institution, you take steps towards making that transition. So yes, as part of the study that Olumide will launch, we had done some review of our loan book, and we found out that most of our assets were brown. And in fact, there were opportunities to increase the proportion of our loan book that was green. And that could mean working with customers to ensure that the projects they bring to the fore meet certain criteria. But unless you understand that, and I think it goes back to what Steve said, there needs to be education, and there are several corollaries, which means that there's the financing side, the access to funding, and then there's also the regulatory side. I'm happy to see the CBN is here because it's a major, major challenge. But I'll keep my powder dry and let other speakers contribute to this, because I think that really is why we're here. Thank you.
Thank you very much. I see that I did say that I have a very able panel. So as we work through this new world of broadband and media online work, we do have disruptions. But then, you know, they say that class is for. At any rate, we have enabled guys, and I'm glad that Sylvanus has taken the reign and actually started the discussion. Now, Sylvanus made reference to the study that we made There were actually 3 banks that took part in that. Wema Bank was one, Sterling Bank was another, and the final one was Stanbic IBTC. Unfortunately, the Stanbic IBTC chief risk officer, who was meant to be with us, had a family emergency this morning. Unfortunately, sending his apologies. But nonetheless, we shall carry on. So, without further ado, Silvanus has actually set the template there, which is the risk that we face. And I like the analogy of the typewriter and the computer. I think, in fact, another analogy I tend to make reference to is the Kodak analogy, where Kodak was the best of brand. They were in fact, if you talk about cameras, you talk about Kodak. But today they're extinct because they couldn't see that train coming in their direction. But I like to think of a better analogy, which is Rockefeller. Rockefeller we know today as one of the richest men in the world. But people forget that Rockefeller's business actually started with kerosene as opposed to petrol. And he discovered petrol by accident. And sometimes opportunity meets preparation leads to success. Rockefeller nearly went out of business because of the advent of electricity. People stopped buying and lighting up their houses using kerosene because electricity came. But then at that same point, when he refined diesel further, he ran into petrol at the point when Henry Ford had discovered a combustion engine for cars. And so, the rest is history. Rockefeller had the petrol, Henry Ford had the cars, and both of them became multimillionaires. There are new products that are coming to market today, but need to be financed. Unfortunately, these products are such that they do not meet the requirements of our current traditional credit risk analysis framework. Yeah. So what do I mean? What do I mean by this? Our credit analysis risk framework speaks to certain parameters. For instance, a company needs to provide 3 years bank accounts. For instance, you have to have been in business for 3 years. Your directors have to have been certain. You have to bring certain collateral to be able to borrow money. But some of these innovative products that we're seeing today, if you look at the energy space, these are new products, new energy. The question is, how do we ask the banks to increase their risk by lending more money to new products at a lower interest rate so that these products can see the light of day and become more bankable? But at the same time, the banks themselves now risk a situation whereby if these products fail, the NPL goes up, and of course the CBN now clamps down on them. So there needs to be some sort of a connection of the dots if we're actually to increase the flow into this space. Now, I used obviously energy as one. We look at places like low carbon buildings, for instance. Housing is another problem in Nigeria. Transportation is another issue. We need to look at how we can reduce the carbon emissions from transportation, agriculture, food security. So the opportunities are immense. But I guess, let's face it, banks are there for a reason. They're there to make profit. So without further ado, I will hand over to Olutoye just to comment on some of the things that Silvana said earlier. I know you guys are doing some stuff in the energy space, but how have you seen the transition, if you will, from where we are today and where we need to be? If you look at the energy composition of Nigeria, for instance, we have something like 89% fossil fuel and maybe just less than 2% solar energy. How do we change that composition? Toye.
Thank you, Olumide. I think firstly, most banks actually understand that climate is much of an opportunity as it's also to risk to existing and future balance sheets. So in general, climate-friendly businesses are said to be good businesses. But then there are 3 major challenges that I will classify that is affecting banks from funding most A&S transactions. First, the banks appear to have been slower than expected in training frontline officers to understand climate risk or A&S risk and to fully include ESG, environmental, social, and governance, in due diligence and in calculating credit risk premium. The second barrier will be the client themselves existing clients, particularly the long-standing ones, most of them appear not to appreciate a higher risk premium due to unsustainable activities. And this is also slowing down our frontline officers from fully imposing premium on existing clients. A way to do this is to do explicit exclusion list, which means ban funding of unsustainable activities. Like the new company themselves, the new climate-friendly businesses. Typically, a majority of the bank loans, less than 10 years, in most cases, 7 years. In most cases, the duration of most banks is maybe between 3 to 5 years. Whereas ESG factors play out over a longer time, even though it might materialize much sooner than expected. So therefore, banks do not often underwrite these types of facilities that are long duration. So these are the challenges the banks themselves could face. But what are the opportunities, or what do the banks need to do? One, there's an urgent need for more capability development for the banks and the businesses. There is need for better ecosystem collaboration, both from the banks and also from the regulators. There is a need to quantify, I know we talked about data, to quantify and manage the long-term risks and have access to finance for green projects. This is where the regulator can also come in. For example, under the European Union Commission, they are looking at introducing what is called a green supporting factor, GSF. And what does this try to do? It tries to amend banks' capital charge for those that are loaning to sectors that are sustainable. What this green supporting factor will do is that it will lower capital requirements for certain climate-friendly loans. So it could be that, look, if you give out loans to those of sustainable lending, transportation, renewable energy, the capital charge that will apply will be lower than the normal conventional loans. What this will do for the banks who are trying to conserve capital is that they have an incentive to also ensure that they grow loans to the green sectors. So this is a major area that regulators will have to look at. The other one could be introducing what I would term a green asset ratio. What are we saying here, essentially? Green asset ratio, the GAR, is to look at the percentage of green exposures of banks as a percentage of total exposure. So what this does, the regulator can also use moral suasion by saying, look, if you are able to achieve a particular percentage X of your loan book to green lending, these are some of the incentives that could be put on board. And this green asset ratio can definitely have an impact on banks' cost of funding, whether it's debt or it's equity. Thank you, Olumide.
Thank you very much, Toye. You've mentioned a number of things there, and you know, when we started this conversation, one tends to start with prescribed questions, but you know, I always like to flow off the back of what you've actually brought up, because that more or less moves us in the right direction. Now, you've brought up a number of things there, which speaks to capacity in terms of people, process, technology. You talked about business opportunities. You talked about even high premiums as well. You talked about, but all of this stuff, and I like the point that you just made there about the green asset ratio, because that's another top of mind conversation that is going on right now at the European Bank. But before we get to that, and before I go to the regulator to maybe offer some sort of in terms of what they're doing themselves, I want to reach out to Ms. Ijoma Ozulumba to speak about what the development bank is doing right now, because I know there's an interlink between monies that you have to put towards sustainable financing, but you offload through the banks. Perhaps you can speak to some of not just the challenges, but perhaps some of the opportunities that you see in this market that the banks can take advantage of. Ijoma, please. You're on mute. You're mute, Ijoma. I think you need to look at the top left corner. There's a mute button on the top left corner there on the control panel. You're still on mute. Just look at the top left corner there. There's your mic icon should be on the top left hand bar.
It's a small red button.
Yeah, I can hear you now. Okay.
Can you hear me now?
Perfect. Please, the floor is yours.
Okay. I don't know why it wasn't working. It was green, but it wasn't working. Okay. Okay. So I was saying that good morning, everyone. Good afternoon. Good evening. Very excited to be here and hear all the conversations around green and also for the launch of the report. Directly to your question, as a development bank, even though we're not so we're just about 5 years old, being set up. But just to talk about some of the things that we're doing around green and our aspirations kind of for the future. I think the first thing is to kind of embed yourself in the ecosystem, which is what I will encourage other development finance institutions to also do, as well as banks. So things like FC4S. Currently, we also sit on a number of international associations on green finance, putting the conversation, getting a bit. Also looking at certifications that we've also been able to acquire as a DFI. So we are in the European Sustainability Standard certification. We got the highest rating. And this is just to prepare ourselves for being a key player in that space. So I think that should be the general direction that we go in terms of preparedness. I also like what Silvano said, and also Stephen alluded to it at the beginning in terms of talent building. So how do we start to build capacity? So lending is good, but if you don't do it in a careful, risk-sensitive way, then it could readily, quite easily unravel at the end. So it's to begin to build capacity of the institutions as well as the loan officers, saying what kind of risks do we expect, how do we mitigate them. Those are the kind of things that we're doing at the Development Bank of Nigeria. We're setting up a green fund. So a lot of our partners are international agencies, and they are very interested in this space. Also looking at using Nigeria as a springboard to the rest of Africa, considering Nigeria's very unique position in terms of population and just how much in terms of GDP compared to the entire Africa. But then in bringing these partners, they expect some standards, which is, I think, where the regulator kind of comes in, and also the entire system. How do we have a common disclosure? That's very important as well. Do we stipulate that, or do we kind of legislate that, or do we continue to leave it at the discretion of the particular entities? At DBN, every year we publish an integrated report, but it would be good to see more of that in the industry so that there's a lot of comparability. We've together with some of the partners, particularly with the German Development Bank. Potentially it will catalyze other lenders, other international lenders, and looking at it, it will be concessionary funding as a wholesale DFI. This will also go to banks, Embedded in that is also a capacity building component. So this will address the talent gap. We'll be able to train banks, loan officers, train institutions with that fund. And that will just explode, hopefully, the capacity that we have within the country. In looking at the fund itself, some of the barriers to funding, of course, we know is interest rates. And so when a concessionary fund is deployed, then it's able to cover some of the green premium, which Bill Gates so eloquently alluded to in his recent book, where it's cheaper for an entity to continue to utilize fossil fuel. And if you want them to then make the transition, there is a premium that it's inherent in that transition, which there is no incentive for them to do that because it's more expensive for them to transit. And a way of addressing this premium, I think locally, domesticating that is to provide this concessionary funding. And so the partners are very well aware of that. And then after that, it will then be how do we measure, how do we monitor, how do we track that, how do we ensure that that gets scale in the country. As a DFI, we focus on small and medium scale businesses. A very important example is the MOU we have with the Rural Electrification Agency of Nigeria. So this seeks to bring SMEs together and do some solar mini grids so that they then have power to scale up their businesses and then become more profitable, become more sustainable. So think about the catalytic effects of that kind of transaction. If it's funded with a concessionary loan, that they can have power, they can scale up their business, the impact on youth employment, the impact on education, the impact on trade, export, balance of payments, foreign exchange. So it just goes on and on and on in terms of what we can do if we really exploit this space and build at scale.
Thank you very much, Ijoma. One thing I picked up from that, and this is before, I'm hoping that our regulator is still with us. Before I go to the regulator, one thing I picked up from what you were saying, that which addresses what Toye was saying, was in terms of training the frontline staff. There's funding there. Now, without putting you on the spot, and it's something that you and I have had discussions about a number of times. I know that when you obviously lend to the banks or lend to your clients through the banks, effectively the entire risk of this is more or less passed on to the banks, because they obviously have to shore up some sort of collateral for the monies which you lend through to them. I'm hoping that you guys will build that into your lending framework in the future, where risk is now shared for certain type of assets. I mean, obviously, I don't expect you to comment on that at this point, because it will require an internal board conversation. But I thought I'd just put it out there, something that I'm sure the banks would like to see. And if we can have some sort of risk sharing.
No, ratio, I can.
Please speak if you can, because the banks would love to hear this.
Okay. So apart from, yes, you're right that we're a wholesale development finance institution. So we take the risk of the banks rather than the, but we also have a guarantee company, which is a risk as well. There's also a component of the funding that targets that area. So we provide guarantees to the banks. We guarantee the loans that they are putting. So this is a kind of ring-fenced area in terms of guarantees, because we understand the whole concept of development banking is to look at where the market gaps are and try to lend in a counter-cyclical way. And I think green finance will be one of such areas. And so in setting up the guarantee company, we're not shy to take on risks. But you look at those risks, you mitigate them either through training, through concessional fund, project finance to do that. So rather than on the balance sheet of the bank or of the company, set up a project, and that kind of mitigates some of the risk as well.
Clearly, there's a lot of work to do in that space, but some of the cynics amongst us will say that you're eating from both sides of the cake by providing the loan and then obviously collecting the guarantees. But
no, but it's not guaranteeing our own loans.
Oh, okay. Hey.
Yes.
Anyway, I need to go to our regulator at this point, because if there's one thing that Toye and Sylvanus mentioned, they talk about, which was the essence of this report and this review, by the way. How do you build an effective reporting framework that allows us to track? Now, I was speaking to a friend recently who I believe is actually online, and he was talking about the fact that there are a number of oil and gas companies out there in Nigeria. I mean, from my perspective, there seem to be a lot of oil and gas companies, but none of them doing gas. But as Silvano said, these are people that will face extinction if they don't change. So I guess the question is, and we'll bring this much later, as I go to the regulator, I want the bankers to start thinking about what we need to do to enable this oil and gas companies to actually transit into being an energy company. But all that thoughts, the bankers. I would like to go to Aruna at this point, Director of Banking Supervision. We've spoken about some of the things that we would like the banks to do, the central banks to enable us to, through some sort of a review of how you address NPLs in the advent that we lend money to more sustainable sectors. Is there a view that the central bank wants to take at this point? Mr. Aruna, Mustafa.
Thank you, Olumide. I momentarily had to switch to another meeting, so I apologize. I was just attending the meeting of my board of directors, and I was called in to make an update. So I didn't quite get some of the discussion that went on while I was attending the other meeting momentarily. But to your question, the whole discourse around climate risk is a nascent, subject, if I must put it that way. For us at the Central Bank of Nigeria, we don't have any regulation currently that speak to the issue of climate risk. But as you know, we have the way back, as far back as 2013 or thereabout, we commenced our implementation of the Nigerian Sustainable Banking Principles, and the key component of that is the issue around the environment. The current template that we have, that banks use in reporting to us on their compliance, with those principles, do not address the issue of loans, non-performing loans, but of course, they provide information on the type of sectors they lend to, and they also provide information on their implementation of some of these principles around the drive towards a clean environment. Yeah, so, but we continue to evolve. It is an evolutionary journey, and we are committed to ensuring that together with the rest of the globe, we all work together to achieve net zero by that target. Indeed, I think Nigeria provided an updated nationally determined contribution, or NDC, if you put it that way, which contains the commitment to reduce greenhouse emissions by, I think, 20% using our local resources, and I think about 45% with international support. So we continue to engage with critical stakeholders in the ecosystem. The banks are a key partner in this endeavor, and so before long, I'm very sure we're following, and we are also monitoring, and we seek to mirror our regulatory regime here to current best practices. So very soon the central bank will come up with a regime of incentives if we feel it is time to do that, but that is at the level of is a discretion that needs to be exercised by the board and management of the Central Bank of Nigeria, but consistent with our overarching mandate to promote a sound and stable financial system, and of course tying that to our other core mandates of ensuring price stability. We'll do whatever it takes to ensure that climate risk, which we recognize as a clear and present danger to all of us, we come up with those regulatory parameters to ensure that we contain its potential deleterious consequences on the environment, and indeed, by extension, the impact it will have, for the financial system. Considering maybe if you especially look at the impact on I want to know the agri sector, for instance. It's easier said than done. A clear example of this was the catastrophic flooding that ravaged farmlands in Kebbi State, which is one of our major, food basket, where we grow a lot of our rice. So you begin to imagine what will happen to output growth, which is one of our core objectives, to increase output growth. So we will continue to monitor, and in the fullness of time, we'll come up with those regime of regulations and incentives that will nudge banks to take the issue of climate risk very seriously in terms of their operations and lending. So thank you. These are just a few comments I will just make to your question.
Thank you very much. Thank you very much, Aaron. And I like some of the things you just said there. One thing that is clear, and
for instance, the Chinese currency.
One thing that's been highlighted today is certain the need for capacity building across the entire ecosystem. That is for sure, and that's one thing that we at Climate Transition Limited have been working with the market to see how best we can bring to bear, utilizing DFIs and other international players, even with talking about the central bank, entities such as the Network for Green Financial Systems, FC4S and the likes. How do we bring all of these people together to ensure that capacity is built? But also my people say that one tree does not make a forest, and I like the way you make reference to the regime of incentives and conditions that you might bring to bear. Since you said that this is a nascent environment, clearly there's a need for all of us to come together to ensure that whatever we put together works for the market as a whole, rather than it just being downwards from the central bank, and then we'll find out that it's not working. To that end, working with the GGKP, we've set up a platform where I'm hoping that those on the table today will be the inaugural members, to be able to actually start to think about some of these issues and some of the incentives needed in the market to move this agenda forward. Now, as I go back to the banks, I want to be a bit more practical, because like I said earlier, there are a number of issues that we're talking about. One, opportunities and more opportunities, but at the same time, challenges. One of the opportunities we talk about, there is no developed nation that got developed without power. And that has been one of the issues that we've had in Nigeria for many years, whether it is at the SME level or even at the massive corporate levels. Yeah. even major organizations such as, and I don't want to point names here, but you know the big industries in Nigeria use diesel to move their business today. Yeah, we need to change that. Even the SMEs, your barber shop, the ladies selling the cokes, they use the petrol. Better part my neighbor. The question is, how do we start to look into those opportunities, those financial opportunities, and enable that side of the market that produces energy for that space? Now, if you look at 4 things that we need: security, we need power to be able to gather data. Education, we need power. Health system, we need power. Everything we do in Nigeria, we need power. So it will appear to me that one of our biggest concerns is the power industry, the energy industry. At the same time, as I mentioned earlier, you've got companies, as you said, who have been benefiting from the so-called oil and gas space for many years, easy money. They employ a large percentage of the population. The question is, we cannot watch them just go to the wall. Some will. It's just the nature of the beast. But how do we move some of those and transit them from being just oil and gas extractive industries to more energy space? I would defer to the back. I want to go back to Sylvanus because I know this is an area that he and I have spoken about before. Please, Sylvanus. You're on mute, sir.
Okay, I was trying to unmute myself. Thank you very much. Thank you very much, Olumide, for that. And really, for me, it just speaks to the fact that, and I think Mustafa from the central bank had already mentioned it, the floods in Zamfara State, for instance, I mean, it just tells you the risks we face, and climate risk is one that is a global challenge. It's an industry challenge, the national challenge. So really, we need the regulator to be at the forefront of driving that change. I would speak to one. I think the physical risks are apparent to all of us. All of us agree that there's global warming. But then the transition risk, also the structural risks with regards to the loans on our portfolio, and also there are policy risks. At a certain point, and the CBN is here, we know that we want to be part of that conversation so that when those changes come, as an industry, we're prepared for it. A lot of times when changes come, they shock the system. And you can imagine that it will be very tough for us. A particular point which we've mentioned, and I think we've gone over and again, is the fact that to be able to fund certain transitions, you need long-term funding. It is true, the nature of our funding in Nigeria is short-term. I do not know anybody that has any deposits in excess of 6 months to 1 year in Nigeria today. Nobody will place his money for 3 years or 5 years. Maybe you might buy government bonds. Again, in terms of the rates that you will need to make these high-risk ventures profitable or viable. So really, the only way forward is to have, and I think Olumide and your team, you're leading this, climate bonds, monies that can be raised at reasonable rates for a long period of time that can be deployed to these solutions. Yes, working with our partners, if we know what we're looking for, how to benchmark this, the kind of thing that we need to be funding. Today we have the likes of Total, Mobil, and the major multinationals, and even they are talking green financing. We have coal and gold mining companies that are talking about how to green their operations. I mean, these are mining operations that are talking of how to green their operations. And indeed, in Nigeria, we must foresee a future where the European countries, the Asian countries have moved away from cars being powered by fossil fuels to electric vehicles. At that point, unless we have also started that journey, one, we might not have anybody producing those cars for us or supporting their repair, and we will continue to have a polluted environment. The last thing I want to talk about, and I think this is of particular interest to me, living in Lagos, is the fact that you also have pollution. Part of that change that we see today is pollution. In Lagos, you have our particulate matter well north of 150 microns per cubic meter. The standard should be 10. Now, how do you work with customers that are using fossil fuels? And Olumide, you talked about power. Power is a key issue. A lot of people fuel their generators. Everybody is running their generator overnight. Today, if you look out, there's a haze in Lagos, and it is permanent. So for me, I think the work we're doing with the DBN, for instance, and DBN has done excellent work in terms of SMEs. As a bank, Wema Bank has been able to benefit from their partnership with the Frankfurt Business School, training our officers. We also need to see such work in terms of climate risks. And again, it's a risk decision because it affects your strategy going forward. It affects the kind of assets you bring on your books. At a certain point, my fear is that we might dilly-dally and we will fall off a cliff, just like we did with the pandemic. So when that transition occurs, we might not be prepared for it. I don't know if I've answered your question, but I've spoken to my pain points.
You know, and I like it when people speak to their pain points. And by the way, I know Ijoma and I have been good friends for many years. For some reason, I always appear to be so hard on her. So I am so glad that you, as a third party, has correlated some of the work that DBN is doing. And long may they continue to do better work. And that sort of brings me to what the DFIs can do. Yeah. So, you know, some of the things that we looked at as part of this review was, you know, how do you report to the regulator? Incidentally, when we started this journey, it was actually to look at the bank's loan books to see opportunities to refinance green assets. But then we discovered how exposed the banks are to carbon emitting projects. And so, you know, the transition in our thinking obviously brought us to bear. Now, as we speak to the regulator, one of the things I actually want to look at is how do you even begin to attract DFI money and begin to make the banks more investable to DFIs as their own mandates actually change? Because there's one thing you said there is, you know, we have this notion in Nigeria. There are three phrases that in Nigeria that really, really gets me going. The first one is usually when things are done, you know, it's always by God's grace. Yes, we know it's by God's grace, you know what? But look, you need to put your own hands to bear and get things done. But we always seem to figure that things will change by God's grace, you know? And then, you know, when we can't figure.
Sorry, Olumide, sorry, we have a fire alarm, so I have to go.
Okay. All right. No worries. Thank you very much for being part of this. If you can join using your phone, that would be great. But we will continue the discussion without you. The next one, obviously, is usually, you know, we stare the problem in the face and we say God will help us, you know. But the point is, you know, at what point do we actually do things? Even countries as small as Rwanda, 13 million population, would disappear in Lagos. They're already talking about e-mobility. These people are already trying to fund electric cars in Rwanda. And I look at Nigeria with a number of cars, as you said, the pollution is just immense and incredible. So transportation is a massive opportunity. People tell me, I mean, I remember when I started talking about e-mobility in Nigeria 5 years ago, people looked at me and laughed.
Olumide, I can see that Dr. Doyin Salami is on the panel now, and I know he has a window of time to be with us.
Maybe we'll pause at this point and bring Dr. Salami in. Can we bring him in, please? Can he switch on his camera and his mic, please?
Mic on.
I think the camera is just next to the mic, sir.
Yeah, it should both be on.
We can see you.
Very good morning.
We can see you. Good morning.
Thank you very much.
Good morning.
Welcome to. Well, very kind of you. I have to apologize because this one is in and out. I just finished a meeting and my next meeting is waiting, but I already had promised that I'd show up. Sylvanus wasn't going to let me be anyway, so I might as well get him off my neck by showing up. Well, that I think I could cope with. I think that I could. Being an economist from Woody, I think I could cope with that one. Let me quickly
perhaps I can just share a couple of. Carry on.
Okay.
So Dr. Salami is the Chief Economic Advisor to the President of Nigeria and also the Vice Chair of the Financial Center for Sustainability, Lagos. Dr. Salami was at the launch of this program 2 years ago and made a key speech at that point. And today we have the honor of his short presence in between meetings, thank you very much, sir, to help us launch this report. He will help launch the report and we'll then we shall go back to the panel discussion. Dr. Salami, I yield the floor to you, sir.
Right, thank you very much. And again, a very good morning to everybody present on this call, and a very great thanks to you, ladies and gentlemen, for the invitation. Yes, you're right. Olumide, 2 years ago when all of this started, I had enjoyed the benefit of being invited, and as I enjoyed the session. And I'm very happy that, you know, at least this is one thing that has been brought to a conclusion. As I'm sure you know, the financial environment is going to tighten up, is already tightening up. And one of the key dimensions of that tightness becomes how do we get investable resources. And as I'm sure you also know, on the back of COP26, and indeed the various conferences that preceded that, one of the key dimensions now is a transition towards climate change, the importance of issues related to climate, related to sustainability. Indeed, my first meeting this morning at 8:30 was actually around climate and economy and all of that. And so it's sort of fitting that this second meeting, albeit brief, you know, continues in that theme. Let me, you know, for me, there are a couple of things that this report does, which I think is very important. The first and perhaps the most important of it is the issues around data. Because what this report that I've been invited to launch does is to provide an analysis of the loan portfolio of a couple of banks. I think 3 banks, if I'm right about that. Looking at the characteristics of these portfolios. Remember that this analysis becomes important in the context of transition. So if we are transiting towards a world where ESG issues, where sustainability issues are at the fore, then it's also imperative for financial service companies, banks in particular, to understand what this means and what they need to do. And therein lies the key for me. Yes, there's data in here that we need to study, but I'm also very happy about the nature of not just the mapping, but also the recommendations. And I think there are probably about 6 or 7 recommendations that kind of, you know, I would highlight. So the first, you know, and a lot of them are around capacity building, because you know, the need to develop programs of capacity building that help financial institutions, banks in particular, to better understand, you know, frameworks for integrating sustainability into their, you know, into their lending policies. Because look, before lending happens, the policies have got to be in place. The second, you know, issue that I think is also important is, you know, technical assistance across various sectors, you know, across the sector that enables, you know, internal capacity to review, you know, the performance of existing exposures, and because that then enables you to begin to see how you can restructure some of these, take some into sustainability financing other than the kind of loan structures that we currently have. Now, of course, there's nothing you're going to do successfully if the role of the if the role of the regulator is not, you know, is not well understood. And so for me, it's also a report that, in my view, would help bank regulators in particular understand how to incentivize lending into this kind of sustainability agenda. And then, of course, how do we do the kind of reporting, that is necessary? And I think, the disclosure of exposure requirements, especially by the task force on climate-related financial disclosure, I think is extremely very important. Well, I already mentioned ESG, and so again, this is one of those areas that the recommendation, in the report covers. In terms of the 6 of these recommendations that I thought were quite interesting, is the need to. I just said a moment ago about essentially blended finance. It cannot all be about loans. There are other vehicles. There are other opportunities that we presently don't take advantage of. It's important now to begin to take advantage of these. Indeed, before I took this role, the last piece I was working on was something called the Africa Clean Energy Fund, essentially trying to position Africa in a energy transition mode. And I think all of these are very, very important. But the last, not certainly the least, I had said human capital development. It's all about training, it's about understanding, and it's about application. And therefore, it's the need for a complete framework that says, let us understand the problem. Let us understand the capacity we need to deal with the problem. Let us upgrade skills to be able to provide that capacity. And then let us be able to deploy and apply in a meaningful manner. Let's not, beat around the bush. Countries like ours are going to face a changed, and I would argue more difficult environment over the next 3 years, over global environment. And in my view, the kinds of ideas that are canvassed in this report are the kinds of advice that are very useful. So, ladies and gentlemen, it's a pleasure to launch this report and wish those who have put it together, thank them, and wish everybody on this call the very best of luck. Forgive me, I can't take any questions. I've just got to disappear.
Thank you very much, sir, for your presence, and thank you for helping launch the program. God bless you, and have a good day, sir. Bye. There you go. The report itself has been launched. The report will be available online. It will be part of this YouTube conversation, and will be around. It certainly will be on our website, www.climate-transition.net. It will be on the FC4S website as well, and I'm sure it will be on the Climate Bonds Initiative website, amongst others. Certainly, a lot of things have come out of all this conversation so far, especially with the recommendation that we made in this report. Data seems to be pointing, and data obviously points to the lack of capacity, points to some of the challenges, but mainly to the opportunities. But I guess it's difficult to start this conversation without even looking at the taxonomy that we need to begin to take on board to enable us actually benchmark some of the information that is required. And taxonomies for me can be used in 3 ways. And before I defer to Toye, because Toye made a number of points earlier when he was talking about green asset ratio. How do you even begin to talk about the green asset ratio when you don't even understand the taxonomy that backs up or even tells you what is green or what is not? So that lends to capacity. But capacity, a taxonomy could be used in 3 ways, or even 4 in effect, because it enables the banks as they develop internal ESG indicators and criteria for even their risk management approach of ESG risks. So you need a taxonomy for that. It also enables the banks even begin to speak of the strategic objectives and targets, as the taxonomy is aligned with sources of investments. Your chief investors at this point, especially for the banks, amongst others, is DFIs. So effectively, you need to realign your loan portfolio, your strategies with the DFIs and make the bank more investable. I know Wema Bank has started some work in that space. That much I know. I don't know about the other banks, but I certainly know about Wema Bank. But also, it allows you to start to design more sustainable products. We mentioned green bonds earlier. We even look at perhaps taking advantage of blended finance products and things like that. But it also allows you to even within the banks from the risk management perspective, and that's why we got risk officers here, in terms of screening, analysis and scenario analysis, and even your stress testing abilities within the bank. I guess the question that we need to come together to start to think of is the data points that we need to start to track and gather, so that enables us not just to gather the data, but mine it effectively and produce that information to the regulator, to the DFIs, so that they don't think we're greenwashing and mixing fossil fuel type assets with green assets just to be able to attract green funds. So the question I want to be asking the banks is, we've spoken about capacity, which leans towards people. There's an element of process, even the technology required. I want you guys to speak to that, Toye and Sylvanus, to give some comfort to Aruna in terms of the data that we need to provide, so that these so-called incentives that we're talking about can be availed not just through the regulators, but also in conjunction and in collaboration with the DFIs. Maybe I'll start with Toye.
Thank you, Olumide. I think for data, which is the major challenge that most banks have had, we need to improve on the data quality and the depth of the data. And we can look at it also, one, from three broad perspectives. The data we are collecting, is it used for quantitative metrics in actually measuring progress? Carbon footprint, is it reducing? Do we have quantitative metrics? Do we have climate risk testing, stress testing, scenario analysis in our report? And what are the disclosures that banks also make to the regulator? At some point, we have suggested to the regulator that even though it's positive that we have the Nigerian Sustainable Banking Principle, which has been launched, but that framework itself needs to go deeper in terms of quantitative metrics, climate risk testing of banks, and also robust exposure. But the issue of data cannot be de-emphasized. For us in Sterling, we've also launched an initiative for data. So essentially, we have a sustainability portal, which is essentially automating. We've brought in external people we can work with, Africa Agriculture and Trade Investment Fund, to also try and develop a robust data platform that will be used for A&S monitoring. And as Dr. said earlier, the data is important, because if you can quantify the risk, you will better be able to measure and also manage it. So quantifying the risk using data becomes very imperative. From the banks, we've talked about incentivizing possibly the businesses. For example, if we have loans that are linked to, like, sustainability linked loans, you talked about oil and gas sector previously. Why are they not moving towards green? What's the challenges? Not only the oil and gas, a lot of businesses are not moving as fast as moving to green. One of the challenges they've had, we mentioned, that is capacity building, but they also need to be incentivized. The banks on their own part, we can look at introducing what we can be a sustainable linked loan. What does this mean? It's almost like a revolving facility where the interest rates can be adjusted depending on the evolution of the borrower's sustainable performance. So if a customer, a business, knows that potentially it can reduce its costs or the interest rate by 200 basis points, if it's able to achieve some milestones by moving towards green, it becomes incentivized. For the bank themselves, they also need to be incentivized from the regulator, whereby we now talked about whether it's a capital component that will be reduced so that bank can focus on lending. But all this has to be done when you have pure data, and the quality of your data is essential, which is why for most banks I'm aware of, they will have a dedicated risk warehouse where data is put there and the data is regularly cleaned. Remember, the ultimate aim is to be able to incentivize both the bank booking quality loans, achieving specific return, and also incentivizing the customers and businesses as they move towards a green environment.
Thank you very much, Sir. I'm quite conscious of the fact that we've got 7 minutes left, and we still have to obviously have the closing remarks by Emmanuel. Before I go to, and I'm hoping he's still with us, before I go to Aruna, the regulator, for a final comment, speaking to Sylvanus now, without naming names, one of the banks that I've worked with in the past, trying to obviously introduce some solar business. One of the things we found out that if you look at the current risk assessment criteria for lending for solar projects, and I'm assuming it cuts across, but I'm sure it can't be too dissimilar. Of the 15 items listed, 19 of those were challenging to a project such as a solar business who just started and is innovative. Now, when you got 19 and you got a group of guys, a group of bankers sitting around the table, traditionally trained to look at things based on experience, and you come to them with a project that has 19 challenges of the 57, you and I know it's not going to pass. So the question is, how do we begin to even address our internal risk assessment criteria so that we can put monies towards it? Look, talk is cheap. Yeah, and I know all of us, we have jobs, we have school fees to pay, we don't want to get fired, and nobody ever get fired for buying IBM. Yeah, but the fact remains that we've got to take a risk somewhere, and unless the current risk assessment criteria is changed, we'll be having the same conversation, and you and I will only get frustrated 10 years from now, at which point we're no longer influential, and we're probably older men and just moan about it. So how do we stop ourselves from being frustrated, moaning old men? By addressing the RAC, please.
Okay, first of all, is to understand the business you're in, and also to be willing as a bank to take on some of those risks. Yes, there are challenges with regards to our regulation. As a bank today, I cannot grant a loan of a certain magnitude without taking some form of collateral. That kind of collateral, in terms of my loss norms, if I take a specialized equipment, for instance, or a solar panel, which I have no technical ability to install, it will probably rot in my in whatever warehouse I've stored it, if I take it as collateral and the loan goes bust. So really, for such loans, project type loans, you need a meld of skills that you need to bring to bear, and the understanding of the regulator also, such that, and I think we've spoken about it a great deal here, in terms of what are the kind of capital accommodations that the regulator can give us, what is the kind of understanding the regulator can give us with regards to these loans. And of course, to be able to finance these projects, these types of projects, and I'm talking to the solar project you're talking to now, for a period that makes it viable, a 10-15 year period, you cannot use your own balance sheet to fund that kind of facility. So yes, it's first of all understanding, and of course at the high point of it, a lot of this will also go to the board, and I think I've spoken about this several times. So this is a conversation we've started in a number of banks, and I know for sure in my bank, the board is fully aware and being constantly educated on climate risk and the changes that we see will come. Yes, it might not be here and now, because we're still looking at Nigeria, and I dare say that a lot of the banks that I've interacted with, at least 30 to 40% of your loan book is in the oil and gas sector, not just in brown industries, but in the oil and gas sector proper. So when do you begin to make that transition? Because that's where your bread and butter is. So I'm also very conscious of time. It's a conversation that we'll continue to have, but risk assessment criteria largely driven by regulation. And when regulation allows us, we can now give these customers some ambit or wriggle room. So if, for instance, I'm able to take a loan that is not fully covered, knowing that this is a startup or it's into solar manufacturing and installation, I give it specialized equipment, yes, but the regulator also understands that this is a preferred sector and they give me some allowances, I'm sure that we can have more joyful conversations, if I may use that term.
I'm not sure if the regulator is still with us, but I don't know if we have any. I would love to take one question, one pertinent question from the audience, if that question is available. In the interim, I will have Ms. Emmanuel Atidare line up his closing remarks. If the regulator is with us, I would want him to just final word from him. But certainly, as you said, this is a conversation that has just started. The launch of the report is not the full stop or the terminal. It's actually the starting point of the train. However, the train has left the station. And I said earlier at the beginning, we've set up a platform and we will co-opt those on this panel because there's no way we can start these conversations without you guys being there. There's a lot of work to do, certainly, and we need all hands on deck to move this, to turn this tanker around. So we will get to that. We will do a lot more work in the background. And as we head towards COP27, clearly we must have something to showcase. It will be great to work hard enough to be able to showcase a reporting framework that we've all agreed to that enables us move this agenda forward. I'm just looking to see if we have any questions from the audience, in the absence of which I would like to thank both yourselves, Mr. Silvanus Eneche, Mr. Lutoye Ambie-Komo. I think I got that right this time. It looks to me like Mr. Haruna B. Mustafa is still on the panel, but it's invited. And of course, Mr. Ijoma, Mrs. Ijoma Zulumba had to leave because we had a fire incident in the office. But if perhaps I can give the final word for the panel discussion to our regulator. We always start with the regulator and end up with the regulator. As we say in Nigeria, they're the ogas at the top, and then nothing moves without their say so. So I'm hoping, and that my prayer is that you will be not just part of this platform that will move forward, but even your colleagues, especially those in the risk side. And Silvanus has assured me that we shall make the connect. We will bring this on board and hopefully have something to bear come COP27 in Egypt. Mr. Mustafa, final word to you, please, sir.
Yeah, thank you once again, Olumide, and thank you to the guests on the call. It's been a very enriching knowledge session. I personally have been enriched in knowledge on the subject, and like I said, for us at the Central Bank, we are poised to support this initiative, and whatever we will need to do, to support the overall drive to a cleaner environment, I am confident that it's receiving support at the highest level, and we'll continue to collaborate with other stakeholders on this journey and provide whatever enabling environment there is, especially for our banks. But again, it is a consultative process. We typically churn out regulations in consultation with the industry that we supervise, just so that we have a regulation that is a fit for purpose and that can, serve the intended purpose. So it's a journey that we are committed to, and in the fullness of time, like I said, we'll look at the need for those regulatory parameters, to encourage banks and, of course, to provide that enabling environment. So those are just the final words I can say. And good afternoon, or is it good morning once again to everyone.
Thank you very much, sir. Thank you very much, all panelists. As I say, talk no, they finish. We started this about 5 minutes late, so I'll hope that the audience bears with us and gives us another 5 or so minutes as I defer to Mr. Emmanuel Ideche to give us his closing remarks. And I thank the panelists, those who are still here and those who are to leave, immensely. Dr. Salami, who had to take time out to join us for your time. And I'm glad that you have given me your commitment that the work will now start in essence. So if they said the reward for good work is more work. So if we've been doing the good work before, now we will start the real work. So thank you very much, gentlemen. I appreciate your time. I defer to Mr. Emmanuel at this point for his closing remarks. Thank you, sir.
Thank you, Olumide. Can everyone hear me?
Yes, we can.
Good morning, good afternoon, good evening, distinguished ladies and gentlemen. I stand on established protocols. It's a pleasure for me to be asked to deliver the closing remarks. I heard my name mentioned a lot by Stephen Nolan, the Global Managing Director of the FC4S Network, and I'm deeply humbled by the comments he has made, particularly the reference to the fact that Nigeria is the first of the 6 countries that received the support from the Global Environment Facility to complete this work. But I dare say that for me, the journey to today started with the meeting in a chilly night in October 2019 in Geneva, hosted by the Mayor of Geneva, where Gugu, who unfortunately could not join us today, Gugu, Justin, and I talked about the benefits of, establishing this project in Nigeria, and through the persistence and determination of certain key persons, including Mr. Mark Hurley, Mr. Bola Nadelekoko, Marcus Mancini, Stephen Nolan, Ryan Meyer, currently, more recently, Nana Ofori, and of course the Olumide who has championed green as far as Nigeria is concerned, and moving across Africa in the last 3-4 years. It's through the determination and the persistence of these persons and some others that I may have forgotten to mention, especially Dr. Doyin Salami, who launched it at the beginning. It's through their persistence that we are today we've launched this report, and I dare say the work starts now, as Olumide has said, and I'm glad the regulator, Mr. Haruna, took time to mention the fact that the CBN, in the fullness of time, I noted that word very well, will come up with the kinds of incentives and policy guidelines that can help us achieve our well-intended goals and objectives for developing this report and launching it. What I look forward to see going forward, and I'm glad Olumide mentioned it, is the fact that there'll be a portal where continuous discussion can be had, where we can meet continuously to keep on talking about the issues and making progress. But I'd like to see going forward also is an update on the data regarding whether this report has helped to shape or reshape the outlook on banks' loans, the extent to which banks are now extending loans to green projects, and how these loans are being progressed to the capital market. Because ultimately, if you want to match the projects with the right funding structure, like somebody mentioned in the course of the call, it's not your one-year deposits that you used to do that. It's not going to work very well. We need long-term funding. We need DFI funding. We need grants, and we need all the kind of supports we can get, blended finance we can get. So thanks also to Mrs. Joma Uzulumba, and as she mentioned, at FC4S we're working on the Green SME Fund that will help to also create more green facilities for established projects that align with green standards. So I'm deeply grateful to all of you for your patience and for the time you've taken to participate at this launch, and I look forward to more interactions going forward. Thanks to everyone, and do have a very wonderful and beautiful day as we collectively agree to work together to help Nigeria achieve its nationally determined contributions and sustainable development goals. Thank you very much.
Thank you very much, Mr. Emmanuel Itedere. On the shoulders of giants, we all stand. So I would like to thank, finally, at this point, those who actually helped start this work. Yes, you made reference to Mr. Stephen Nolan, who was obviously the keynote speech. But obviously the work started many years ago. So I'd like to thank my ex-colleagues at CBI, Climate Bonds Initiative, especially Justin Libel, who partnered with me on this journey in Nigeria of evangelizing the virtues of green finance. And more importantly, I would also like to thank the what might call the guinea pigs, Axis Banks and NSP Power, who obviously have launched green bonds and shown that it is possible to do this, but also the sovereigns who went through a lot of work at the Ministry of Finance as well as Ministry of Environment to even launch the first certified green bonds in the world. Nigeria, we did that. But as we look to the future, my new colleagues at Climate Transition Limited who would help carry this work forward. But you know, the important people are the clients, the banks, the regulators, the DFIs, the banks, and the government. We in this together. But this today could not have been possible without the technical team behind this. Ryan Meyer, Camille Adair, and a team, they made this possible. Thank you very much for this platform to enable us to have this discussion today. I thank you all, and you have my gratitude. I look forward to working with all of you in the future. As we approach COP27, let's fly the Nigerian flag. Let's get things done. Let's have a poster child. This framework that we talk about, let's make it happen. And I'm sure together we shall green up this economy and reduce the risk that we face as a country. Thank you very much and have yourself a wonderful day. And for those who took time to attend, the audience, thank you very much. I greet you and I thank you for being here. God bless you all. Thank you, gentlemen. Have a good day.
Thank you.
Thank you.